All right, now we talk a lot about the importance of saving on this podcast, but equally, if not more important, is investing those savings to help you take control of your financial future, which has never been more important. But with nearly half of Australian adults considered financially illiterate, investing can feel confusing, risky, or out of reach for many of us. However, according to Scott Phillips, the Chief Investment Officer of the Motley Australia, the problem isn't that investing is difficult, but that it has rarely been explained in an accessible way. Scott is the author of a new book, The One-Page Investing Plan, and I'm pleased to say he joins us now. G'day, Scott. Welcome to the Savings Tip Jar.
Don Denise, thanks for having me. You've done a great job with the intro because the issues you've identified are exactly why I wrote the book.
Oh, and before we get into all those issues everyone's dying to know, what's your savings tip for us, Scott?
Here's my one, is don't have lazy money. Make sure your money is actually being, when you've made the savings, put to work in a high interest savings account. We know there are billions of dollars in low or no interest transactions accounts around the country. Shifting that across into a higher, preferably high interest account, that is going to have your money making money even before you start investing it.
Yeah, absolutely. 100% agree with that one, Scott. Yeah, people didn't really tell me much about any of this stuff till I was, I didn't learn about it till I was in my mid-20s really. But, while I was through uni, while I didn't have a whole lot of savings, I still had, a few grand here or there. But I just had most of it sitting in a transaction account. And I could have done with, the few $100s or so of interest I could have earned by having it in a high interest savings account back then. But I didn't learn that until much later. But I dare say there's probably some people well into their 30s, 40s that are still doing that. So that's certainly a good savings tip. Now, your new book, Scott, The One-Page Investing Plan, we'll start off with that one. Just give us a general summary of what it's all about, and also, who should read it? What can people expect from it?
Yeah, look, I really appreciate it, guys. And by the way, so if you want to buy the book, buy the book. If you want to get it from the library, do that. I'm not here to push the book necessarily, although I hope it's actually useful for people. And that's kind of your point. And I'll give you a very quick backstory to answer your question. I have the Vanguard Index chart. It's a chart that shows the 30-year history of the ASX. And it was up on my wall because I'm a nerd. And I had an internet guy come and fix my internet. And he looked at it and went, "What's that?" I said, "Well, here's what it is." He said, "How do you do that?" Or no, it was, "Can I do that?" I was like, "Yeah." He said, "How do I do it?" And I thought that literally is the genesis of the book, is trying to help everybody take control of their finances. And obviously it starts with savings, as you guys know, but then turning those savings into investments and then having that build over your life, that's the next stage in the process. And you're right, it's absolutely doable by absolutely everybody. As long as you got the spare money. Now, some people don't have the spare cash, right? And I get it. So I'm not saying everyone, just regardless can do this. If you can save $1, you can invest $1. And that's the key. But how do you do it is the first thing. Secondly, how do you stay invested? What should you expect? And I mean, there's the standing joke, right, is the one-page investing plan in a 300-page book. So, can't I just have the one page? Everyone, I suspect, knows, or frankly could ask ChatGPT these days, what should I do? Or how do I invest? And you get a list. And the list is really important. And that is literally the heart of the book, right? Is here's one page. Do these things is the idea. But if all you see is the list, the how you do those things, and most importantly, how do you keep doing those things when everything around us is trying to distract us, put us off, fear, greed, impatience, other priorities, how do you stay the course? And those two things together are really the heart of the book. It's all about saying, here's all you need to do, and it's never been easier to invest. Online apps, index tracking, exchange traded funds, we won't get a whole lot of detail. These things are there for you. Just putting the Lego blocks together is all you need to do. And that's the idea of the book, is to help people firstly understand what to do, and secondly, understand how to do it, and thirdly, how to stay the course.
It sounds like a really great plan, but as you say, there is always a little bit of fear out there about these things. And probably the current environment, we've got a bit of interest rate drama, and we've got all those investor tax changes, not to mention a bit of global conflict in the Middle East, and a bit of AI thrown in even. So, can you see that puts people, they don't understand those things, and they fear treading there?
100%. Here's the other thing though, Denise, is that's always been true. The list was different 3 years ago. It was different 5 years ago. It was different 10 years ago. It was different 30 years ago. And again, the Vanguard Index chart, if your listeners Google it, do yourself a favor because it's really great. At the top of the chart, and we can't do this easily in this format, but there's actually the things that happened in the world. The presidents, the prime ministers, the exciting and scary economic impacts over the 30-year period. So here's a really quick set of numbers. 10 grand, a hypothetical 10 grand, invested in 1995 became $143,000 30 years later. What did you have to do? Nothing. Literally nothing. But what you did have to do was exactly nothing, i.e. stay the course despite what was going on. Think about that 30-year period. We had the dot-com crash in 2000, right? The NASDAQ lost 85% of its value. We had the GFC. We had the COVID crash. We had terrorist attacks. We had China was going to fail. The system was going to melt down. All of those things that could have happened, and many that actually did happen, right? Despite that, the market managed to grow 14-fold in value. So you're absolutely right. There are so many reasons to look around and go, I don't know what to do. It feels scary. It feels risky. I might lose my money. I don't know what happens next. It's Trump. It's oil. It's terrorism. There's a million reasons, right? And I'm not downplaying those for a second. They are genuine and well-held concerns. Some of those will actually hurt the economy at some point. There were probably 2 or 3 recessions in that 30-year period. By the way, the US market did even better than Australia, and they had more recessions. So work that one out. So yes, understand the fear. Totally get it. Part of what I write about in the book is exactly that volatility. Here's the really scary part, right? COVID happened. And in a month and 4 days, the market fell by more than 35%. So was that 35 days, let's call it? You went from having $100 to $65, or 10 grand to 6.5 grand, 100 grand to 65 grand. If you had $1 million, you lost $350,000, right? That is gut-wrenching. And wherever you are on the journey, that felt and is scary. But the market had the fastest recovery in history, as it turns out, and within a year or two was well above the level you were before it fell. So part of this is absolutely, I said before, staying the course. And it comes down to understanding history, understanding that fear is real. Some of those events, as I said, it's not even a rational fear, it's very rational fear. But the market has always, over 125 plus years, gained more than it lost through 2 world wars, a Great Depression, 2 now global pandemics, regional conflicts, 2 oil shocks, 2 bouts of hyperinflation or high inflation. We've actually seen that happen, and yet the market still grows. Doesn't mean it's not going to be volatile, so be ready for those big, gut-wrenching, just freak-out falls, because they'll happen. But also remember that over time, the market goes on to go back to and then higher than the previous high. And if you can internalize that, it's not going to make it feel any better. But if you can separate the 2 parts of your brain, the part of your brain that says, oh my God, I am just having a moment right now, and the other part that says, I know you are, just keep going. Again, not easy to do, hard to do. I did it during COVID, right? I made some bad investments during COVID too, by the way, not just great ones. But I went, this sucks. I'm losing money. I'm losing a lot of money. This is awful. I don't want to do this. I want to get off. But I said, but I knew this would happen. And I knew that I would feel this way. And I knew that I would decide to invest anyway, because history tells us is always, thus far at least, been the right decision to make. So yes, confront those fears, accept those fears, understand them, and in my mind, invest anyway over the long term, because the market creates value.
Yeah, certainly when you zoom out, it does look like time has a habit of ironing out all those bumps, and the market does seem to generally continue heading on in a northeasterly direction. But potentially that sort of trajectory is a bit steeper in other markets. You mentioned the US market, how that has grown even more than the Australian market in recent years. Just people I've been talking to, a lot of them are saying that they don't really see much investment potential in Australia as much as overseas. So I wanted to get your take on that, that sort of Australia versus overseas. Do you think, the Australian market it does seem like, over the last year, I think ASX 200 is only up about a bit over 3%. Whereas in the US, a lot of their stock standard indices, the S&P 500 or the NASDAQ, they're all up over 20%. So yeah, do you think there are currently better growth opportunities overseas? I mean, it actually even seems like my super fund seems to think that way. I'm just looking at the portfolio makeup, and a bit over half is invested overseas. So what's going on there?
It's a really big question. I'll try and keep it short. So a few things are happening. Firstly, yes, there's more growth in the US right now. Why? Because the biggest companies are growing fastest. And that is kind of that symbiotic relationship. Why are they growing fastest? Well, because they're biggest. Why are they the biggest? Because they've grown faster. So it's a bit of a chicken and egg. They are the ones, this sounds like a horrible marketing tagline, I promise you it's not. They're the ones inventing the future. So who are the companies that are biggest and growing fastest? Electric vehicle maker Tesla, social media company Meta that owns Facebook, WhatsApp, Instagram, chip maker NVIDIA, which is powering the AI boom, Microsoft, Google, Apple. software and hardware companies that are just absolutely going bananas, right? Because they're harnessing the stuff that's going on. So you mentioned before, Denise, the risk of AI. We're also seeing the reward of AI thus far, at least. Amazon, I own shares in Amazon. It is growing at a rate of knots. Cloud computing, AI, retail. So the combination, it's really, really impressive, Dom. And so the growth is real. And it probably will continue to grow faster, I suspect, than the Australian market. Why? Because of the makeup. We've got banks and miners. Banks are massive, but they're already the whole market. They can really only grow about GDP plus a little bit maybe over time because they've already owned the entire, unless they expand overseas or do something else, they've kind of got the market. Miners, some really high quality long-term businesses there, but are they going to grow at .com rates? No, they're not. So you've got a very, very, very different makeup. I would say a couple of things. Firstly, I haven't got the numbers in the last 2 years. As of 2024, I think it was, yes. The Australian market actually outperformed the US over 125 years. So time frame matters a lot. Also, over the last 3 months, by the way, the ASX has done better, I'm pretty sure it's certainly the last month, than the US market. So time frame matters. But I also expect that in different parts of different cycles, we'll see different things. Here's some numbers. I'm not going to bore you with a whole lot of detail. Over the past 5 years, oil or energy, the energy sector, we call it, basically oil and gas, and the tech sector have operated almost exact opposites and by big margins over the calendar years. So one will be up 30%, one's down 40%. Next year, one's down 40%, the other one's up 30%. And they've kind of tic-tac. Now, I'm not saying we should trade a yearly in and out. What I'm saying is in individual periods of time, investor sentiment and, frankly, macroeconomic conditions change really quickly. And so what we've seen over the last year, you're absolutely right, mate, have done fantastically well. Some of that is the businesses are growing. Some of that is investors are simply bidding up the prices faster than growth. And in that scenario, you generally find that if the share price gets ahead of earnings, there may well be future periods where growth in share price isn't quite as strong because earnings are catching up. So I wouldn't look at the last year and make any decisions. I will say I absolutely own international shares directly, and I own international ETFs. I own Australian ETFs and Australian shares as well. So I'm not saying do either. Well, the point is don't do either or is my view. I would absolutely want to be invested overseas for all of those great things. Currency diversification, geography diversification, sector diversification. Some of the companies that you can't get access to, the Amazons and the Apples and the Facebooks of the world in Australia. So you want to own them, and you've got to do it on international markets. By the same token, remember here at home, when tech has a bad year, because it's going to at some point, maybe it will be Australian retailers or telcos or media companies or maybe the banks and miners that do better. And so I wouldn't say you need to decide either or, and I definitely wouldn't just bet on one or the other because you don't know what's coming next from earnings or from share prices. Remember the .com crash I just mentioned before? The Nasdaq fell 85%. Now, Nasdaq's gone on to outperform since then, by the way. So again, I'm not even saying they can't do well. All I'm saying is just because they've done well, the .com bust followed the .com boom, where things got really wackily out of kilter. So I own both. I reckon people should invest in both. You can do it, by the way, on the Australian Stock Exchange because you can buy international ETFs, exchange-traded funds. Again, we won't get to the jargon, on the ASX. So you don't even have to have an international brokerage account. You can do it right here. So yes, there are some exciting, high-growth, really great companies in the US. I don't think we should forget here. Last one very quickly. Australian dividends often carry tax benefits you can't get internationally. So there are other reasons to invest in Australia as well as investing overseas.
Now, we've spoken about the Australia-overseas divide. Here's the other big divide that always comes up, and it's the old property versus shares. Are ETFs, which you've mentioned, exchange-traded funds, going to be sort of the new residential property for mum and dad investors?
I hope so. And I just people say, "Oh, you say because you're a shares guy." Here's the funny thing about it. Two things. Firstly, I'm a shares guy not because I work in a company that does this. I actually left my other job in industry to join the Motley Fool because I like what they were doing. Right. So the idea was I'm not just shilling for shares because no one. I mean, I hope your listeners are getting some value out of the conversation, but I'm not going to move markets. Right. So am I just going to promote shares for promote shares? No. I think they're a really great way of building wealth, and I'll come back to that in a second. So that's important. The second is I like money. And so if I can make more money buying a property than buying shares, I'm going to buy the property, right? I'm not that silly. So I try to be agnostic, at least in the approach. I can't promise to be entirely unbiased, but I try to be agnostic in the approach, and then I'll buy whatever asset makes most sense. Here's the thing about property versus shares. Property is literally, as a sector, every building and land in the country, right? Residential property, commercial, we can put some differences there, but effectively it's everything, right? What are shares? Yes, it's every share in the country, but there's about 1,800 companies on the ASX. There's 2-point-something million businesses in Australia. So when you talk about shares, you're not really talking about the business sector. You're talking about a really, really small number of companies that probably are on average, some are terrible, by the way, on average better than the rest because they get to list on the stock market. People want to buy their shares. If I had a private company, I could list it and make a fortune, I'd do it. So you can assume that most of the companies on the ASX are bigger or better than their competitors, or at least have something going for them. So it's not even a fair fight. If you said to me, Scott, you can pick the top 0.1% of properties and call that the property index, the property stock, the Australian Property Exchange, if you like, then I'd have a different conversation, different answer. But right now, we know over time, and here's some numbers, the Australian share market over the last 24 years I talked about before, 6% roughly before inflation. At about 3% inflation, again roughly, you're about 9% per year. The economy grows about 2.5%, maybe 3% a year if you're lucky. So you've already got a market that's well and truly outstripped economic growth, right? Think about property. Property's done extraordinarily well over the last 40 years. We all know that. Falling recently. But prior to 1980-ish, property grew roughly at the rate of wages, as it should have. So moving forward, what's likely to grow faster? The entire property market that has only wages and debt to grow, or a small subsection, on average, of the better businesses in the country that have historically grown at 9% per year? I don't think, I can be entirely wrong, right? So this is my supposition. Business has more headroom to grow because if property grows at double the rate of wages for any extended period of time, eventually mortgages cost 110% of your wage, and that can't happen. So, well, maybe it's tenants. Okay, well, the landlord's got to pay back the loan with the rent. Now, I think if gear is going away, you mentioned that, Denise. But even then, the rents can go up, but only, again, up to a certain proportion of income. You've got to put food on the table. You've got to put the kids in clothes. You've got to drive the car. So there's a natural ceiling. I don't know where it is, but there's a natural ceiling to property prices as a function of wages. The subset of companies that trade on the stock market, there's no ceiling. Why? Because they can always grow internationally. They can buy another competitor. They can put another competitor out of business. They can produce new products. They can become more efficient. There's a lot more potential, I think, for raw upside in the share market as a group than property as a group. So that's the answer. So do I think ETFs, exchange-traded funds, become the residential property of the future? I hope so for those people's sake. Yes, I think the returns will be better. I also hope, by the way, it's not part of this conversation, Australian property needs to be cheaper for our young people. We are really, really, really messing with them. And I own my own home. I don't own investment property. If my house price falls 20%, then it's good. I don't care. And you say, well, it's easy for you to say, Phillips. It's not because I don't want to make money or want other people to lose money. I want, frankly, my kids to be able to afford to buy a home. I want other people's kids to be able to afford to buy a home. So, a whole different story. But if people are investing in shares, I think their upside is better, I suspect. The tax benefits, I suspect, will be better. And I hope that will mean fewer investors in residential property. Not none, because we want landlords, people who want to rent or can't buy, don't choose to buy. But I hope that transition will be better for those people investing and better for the housing market in general.
Great points there, Scott. Very, very well said indeed. Now, you've been very generous with your time. We've gone way over time, but I just wanted to quickly hear from you. What are your top investing principles before we say goodbye to you?
Cool. Save regularly, invest diligently, diversify properly, and stay the course.
Brilliant.
That's literally it. I will throw in reinvest your dividends, actually, because people don't always think about that. But that's it. That's the book, right? It's really people read the book and go, yeah, we know all that. I was like, good, so do it. Like actually take the lessons, take the plan. I'm not promoting the book, by the way. I'm just saying that's literally all that's required. It is not hard. Everyone, if you can save $1, you can invest $1, and you can invest it well with just a couple of bits of information. So yeah, they want to leave your listeners with.
That is one page. Well done.
Thank you.
Yeah, great note to finish on. Scott Phillips, really appreciate your time on the Savings.com podcast. Thanks so much for your insights.
You've been very generous to have me. Thank you.
Cheers.
Bye.